Hi students. So this is the fourth video of section E, internal controls in CMA USA part 1. So in the last video we have seen FCPA, Foreign Corrupt Practices Act, and Sarbanes-Oxley Act. As a continuation of that, today we are going to see testing the adequacy of internal controls. Responsibility of management. Management is responsible for establishing and maintaining an adequate internal control structure that provides reasonable assurance regarding the reliability of financial reporting. So this is a continuation of Sarbanes-Oxley Act. If I go back and see a little bit, this is where we stopped. Sarbanes-Oxley Act had many sections. 7 of them we studied. PCAOB and services outside the scope and practices of auditors, audit partner rotation, audit reports to audit committees, corporate responsibility for financial reports, management assessment of internal controls. Finally, disclosure of audit committee financial expert. All this we have seen. Now we are continuing from there. So responsibility of management regarding the effectiveness or adequacy of internal controls. First one, management is responsible for establishing and maintaining an adequate internal control structure. Management is to base its assessment on a suitable recognized control framework. And most US companies use the Internal Control Integrated Framework 2013, published by COSO, as the benchmark, as a framework. According to COSO framework, monitoring the control system by management is required for the purpose of assessing the operation and effectiveness of existing internal controls. Types of monitoring. Monitoring can be done as ongoing evaluations and separate evaluations. Ongoing evaluations are built into the business processes. So it's a regular one and they are set up to occur automatically. Ongoing evaluations use software to monitor transactions and test every single transaction processed for compliance with selected criteria, such as to test for purchase orders issued for amounts greater than the approving employee's authorized limit. The software generates an alert whenever an exception occurs, so it can immediately be investigated. Ongoing evaluations can generally identify problems more quickly than separate evaluations. So these are routine ones. Another example for credit card companies. When you use credit card from an unusual location, it generates a flag. Immediately it's notified. Another one, Google. You log in from an unusual location, Google send you a notification. Or if you log in from an unusual device, Google send you a notification. Did you log in? So these are all ongoing process. Regularly it's being there. Whenever the limits are exceeded, whenever anything unusual is happening, they generate a error report. Separate evaluations may also be done periodically by management, by internal audit, or by external parties. Separate evaluations can be used to confirm results from ongoing evaluations. Separate evaluations means, taking certain transactions and double checking, getting the source documents, confirming with the other parties who are connected, double checking. This is separate evaluations. You don't do it on a regular basis, time to time. If you have anything suspicious, if you have anything that you want to verify, you verify it. The effectiveness of controls. The effectiveness of an internal control system depends on two things: design of the system and of the individual controls, and whether the controls are operating as designed. Any system, these are the two. First thing, you have to design it properly, whether design considers all the risk factors, whether design has accommodated all the possible risks. And then design is one. You may have the best design, but if you don't implement, if people don't take the internal control policies and procedures seriously, then there's no point of the design. So design as well as implementation. Selecting the controls to test. The SEC's guidance for the management assessment of internal control over financial reporting prescribes a top-down risk-based approach. We saw that earlier also, a top-down risk-based approach. Management should focus on key controls, the controls that are needed to adequately address the risk of a material misstatement in its financial statements. So basically, you start from the financial statement, the top level, things that affect the whole organization. Then from there, you go into details. Types of tests of controls. Inquiry, asking management and staff for an explanation. Observation, watching the processes. Inspection, the examination of documents related to control procedures. Re-performance, manually executing the control. For example, recalculating something that the system has automatically calculated. So we saw 4. First one, types of test. First one, inquiry. Second one, observation, inspection, and re-performance. Classifying deficiencies. If you have any shortages, if you identify any issues with the system, internal controls. One is known as deficiency in design, other one deficiency in operation. We have seen that if internal controls have to work perfectly, if it has to give the intended results, first thing, it must be designed appropriately. Second one, it must be implemented. So both of them may have deficiencies. Any deficiencies identified in testing need to be further classified as one of the 3 types. First one, control deficiency exists. So you see the name. Control deficiency exists when the design or operation of a control does not allow management or employees in the normal course of performing their duties to prevent or detect misstatements on a timely basis. Repeat, a control deficiency exists when the design or operation of a control does not allow management or employees in the normal course of performing their duties to prevent or detect misstatements on a timely basis. So it doesn't allow the management to identify the misstatements. You call it control deficiency. Second one, a significant deficiency is a control deficiency or a combination of control deficiencies that is less severe than a material weakness but important enough to merit attention by those responsible or for oversight of the company's financial reporting. Significant. Material weakness is a deficiency or combination of deficiencies in internal control over financial reporting such that there is a reasonable possibility that a material misstatement of the company's annual or interim financial statements will not be prevented or detected on a timely basis. Control deficiency means in the normal activities, normal course of business, the management and the people involved will not identify the misstatements in the financial statements. And this control deficiency, then there are 2 types, significant deficiency and material weaknesses. Significant deficiency means one or few control deficiencies, not very severe, but still important. Material weakness means one or more control deficiencies which are more significant, more severe. If there is one or material weaknesses in the company's internal control over financial reporting, management is not permitted to conclude the company's internal control over financial reporting is effective. So if there are more than one material weakness available in this third category, if there is more than one material weakness is identified, you cannot say your internal control is effective. Basically, it's ineffective. A company needs to report any material weaknesses in SEC filings. Remember, any material weaknesses must be reported in the SEC filings. Companies also need to include information on their remediation efforts, implementation timeliness, and progress towards remediating the deficiency or deficiency. So, what corrections you have taken, how you are going to remedy the deficiency, you have to inform. If a material weakness has caused a material misstatement on previously issued financial statements, amended financial statements will need to be filed along with explanatory disclosures. So, by the time you identify the material misstatement, material weakness, maybe because of the same weakness last year, previous year, sometimes the misstatements might have happened. So now we have to restate all those financial statements and we have to give an explanation what we have restated and what's the reason. Remediating control deficiencies. Deficiencies should be prioritized for remediation according to their severity of classification. If you identify many deficiencies, In the severity order, you take the deficiencies for remedying. Material weaknesses should have first priority, then significant deficiencies, finally control deficiencies. Control deficiencies should be remediated if the benefit or remediating is judged to be greater. Anything, that's what we do. You compare the cost and benefit. If benefit is more, then you do it. However, any control deficiencies that are not remediated should be re-evaluated after a reasonable period to determine whether they may indicate a material weakness. That means at one point you excuse me, at one point you might have identified that as a control deficiency which is not so serious, which is not material, but after some time that might have become more significant. It might have become material weakness. So time to time we have to re-evaluate which ones. If you had any control deficiencies which you did not remediate, you just left it as it is. Why you wouldn't remediate it? Maybe you thought the cost of remediating is more than the benefit of remediating, so you did not remediate. Fine, but after some time you must do a re-evaluation whether that control deficiency remains at the same significance level or whether it has improved or increased as a material deficiency. Remediation actions. Determine the root cause of the material weaknesses or deficiency. Create a remediation plan. If necessary, plan and make new investments in IT, in personnel, and in other resources. Outside experts may be needed. Monitor the progress in implementing the remediation plan and hold responsible persons accountable. Keep all stakeholders, such as members of the audit committee and independent auditors, informed of progress towards meeting the goals. I don't think there is anything new to you. Just the usual, remediation plan. Identify the root cause of the weakness. Come up with a plan for it. If needed, make investments into IT or people. Monitor the process in implementing and keep all stakeholders such as audit committee and independent auditors informed. Ongoing actions. All material weaknesses should be re-evaluated at least quarterly in order to update the disclosures. SEC filing should update progress made towards remediating material weaknesses. After the remediation is complete, monitor the remediated control. If necessary, make further changes. Well, so that's actually part of the previous lesson, Sarbanes-Oxley Act, and evaluating the internal controls related, that we have seen those theory points. I would strongly suggest with this discussion, you have to better read the textbook at least once before the exam, especially section E and section F. Section A, B, C, D, you don't necessarily have to read the textbook because it's mostly numbers and I have covered everything in the discussions. But section E and F, I have taken the salient points, important points, but still good to have a read at least once before the exam. So, you will have a better understanding on these sections. Moving to the next part, the external auditor and their report. Responsibilities of external auditor. Responsibility of the external auditor is to express an opinion. Very important. What do? They give an opinion on the financial statements. They say whether the financial statements are true and fair, whether it gives true and fair view of the company. Under the PCAOB audit, they also must issue a report on internal control. So these are the responsibilities of external auditors. Why we say PCAOB audit? If they are auditing a public listed company, then it is coming under PCAOB. If they are auditing a limited liability company which is not public, which is not listed in the stock exchange, then you don't have to issue this report on internal control. But if it is PCAOB audit, you have to. So these are the types of opinions they give. Opinions means, they give a one-page statement to say what their opinion is about the financial statements. Unqualified means that's a good one. That's a good one. What is a good one? The financial statements present fairly in all material respects the financial position, results of operations, and cash flows of the company in conformity with generally accepted accounting principles. So basically, they feel things are good. The company has all the source documents. They could verify most of the transactions. and the accounting entries have followed all the US GAAP requirements, they don't see any issues. This is unqualified. Then we have another 3, qualified adverse disclaimer. Qualified means almost. Qualified means there are issues maybe specific to certain aspects, certain transactions of the business. It doesn't affect everything. There are minor issues, you can say. In that case, they give still the financial statements with an opinion known as qualified opinion. So not 100%, something like, okay, 80%. There are issues in certain areas, but fine. Still it's fine. Adverse opinion means too many problems. They have identified too many discrepancies, too many areas of conflict, which is in many aspects of the accounting statements. Then they give adverse opinion. So this is quite bad. This is like 30% marks. Disclaimer means the auditor could not do the audit process in a proper manner. Either the client, the company did not provide them the source documents, company did not support them, or they had been a legal case. Because of that, the documents could not be retrieved. So auditing could not be done in an appropriate manner. So they are like, this is the financial statement, but we don't know what is in it. We don't know whether it is fair or unfair. No idea. So that kind of statement is known as disclaimer. Basically, audit could not be carried out appropriately. Audit risk. The risk that the audit opinion is incorrect. Of course, auditors also might give incorrect opinion. This is known as audit risk. Made of 3 risks: inherent risk, control risk, detection risk. Let's see one by one. First one, inherent risk. What is inherent risk? The risk that is natural in the function being audited, assuming that there are no controls. That means certain functions are complicated. They are susceptible for the risk, susceptible for more mistakes. For example, see the paragraph below. An example of an inherent risk is the calculation of pension liabilities, which by nature are extremely complex. So there are chances people might make mistakes. Because it's complicated area, you call it actuarial sciences, actuarial calculations, pretty complicated area. You even use advanced maths into that, right? So this is known as inherent risk. Assuming there are no controls, just, when somebody is doing this activity, the chances of people making mistake in it. Certain activities, the risk is high, that you call inherent risk. Second one, control risk. Control risk means risk that an internal control will not prevent or detect a material misstatement in a timely manner. That means even after having the control, the chances that control is insufficient. People either bypass the control, or people collude together. They get together and they do circumvention of the controls. So the controls can be insufficient. This is called control risk. Third one, detection risk means the auditors might fail to identify the misstatements, right? So misstatement has taken place, control did not identify, that is control risk, and the auditors must detect it. If auditors also miss it, that risk, the chances that auditors missing a misstatement, is known as detection risk. Well, so that's all about the auditor's opinion and the related risks. Now, let's go and see some questions on this. External audit opinions. There are only 9 questions, it seems. Let's take all 9 of them. First one, when assessing a company's internal control structure, policies and procedures, the primary consideration is whether they affect the financial statement assertions. Because Sarbanes-Oxley Act wants the management to assess the effectiveness of internal control procedures and policies to ensure there is no misstatement in the financial statement. So the primary consideration is whether they affect the financial statement assertions. An audit of the company financial statements of Camden Corporation is being conducted by an external auditor. External auditor is expected to certify, express an opinion as to the fairness. We have seen that this is the primary role of them. What is it? Express an opinion as to the fairness of company's financial statements. An auditor, an annual audit for a US publicly traded company that is non-accelerated. Okay, we did not see this in the slides. Accelerated filer, non-accelerated filer, and large accelerated filer. There are three types of public companies. Large accelerated filer means the public float must be more than 700 million, if my memory is right. I think 700, yes. That means the value of shares that they have let for public to buy and sell, you call it public float, not privately held by the promoters, original owners or anything. It's there on the public float. If based on the value of public float, they have three categories: large accelerated, accelerated, non-accelerated. 700 million and above public float, large accelerated filer. 75 million to 700 million public float, you call accelerated filer. Less than 75 million public float, non-accelerated filer. So what will happen? Certain regulations, certain restrictions will be lenient on non-accelerated filers. So let's see what this question is about. The external auditor provided an audit opinion stating that the financial statements presented fairly in all material respects. The financial position of the company as of the balance sheet date and results of its operations and its cash flows are for the period then ended in conformity with applicable financial reporting framework. So this is all good. He has given an unqualified report. However, the auditor did not attest the effectiveness of management's internal control over financial reporting. Remember, I said external auditor has two roles. One is giving an opinion on the financial reports. Second one, assessing the effectiveness of or basically attesting management's assessment on internal control. Management has to do the assessment on internal control. The external auditor has to attest that assessment. But here they have not given that. Were the financial statements in violation of Section 404 of the Sarbanes-Oxley Act? See, this external auditor has to attest the assessment of internal control done by management. This is applicable to large accelerated filers and accelerated filers. Non-accelerated filers, even if they did not attest it, it is all right. So this is not a violation. No, because the requirement for independent auditor to report on and attest the effectiveness of management's internal control over finance does not apply to non-accelerated filers. Last one. One of the financial statement auditor's major concern is to ascertain whether internal control is designed to provide reasonable assurance that financial reporting is reliable. Next. I think that's easy. Top-down approach to the audit internal control over financial reporting can best be described as beginning with interviewing top management and observing the actions. No. By identifying significant accounts and disclosures for each assertion at the financial statement level, focusing on entity level controls. Yes, top down, focusing on entity level controls and working down to significant accounts and disclosures. Yes, that must be the answer. Yeah. A US publicly traded company that is classified by the SEC as accelerated filer, this time accelerated, completed its annual audit and internal control assessment. Its external auditor attested the financial statements by giving an audit opinion, but did not include an opinion on the effectiveness. So this will be a violation. Why? This is an accelerated filer. If the auditor did not attest the effectiveness of the company's internal control, that can be a violation. Yes, because external auditor did not attest. Yes, that has to be a violation. Next. An audit firm is concluding its audit of a publicly traded company in the US after obtaining sufficient audit evidence. An external auditor concludes that misstatements in aggregate are material but not pervasive to the financial statements. Guys, this is the exact wording to explain when to give qualified opinion. There are misstatements that are aggregate, that are material, but not pervasive to the financial statements. This is exactly qualified opinion. An external auditor discovers that payroll supervisor of the firm being audited has misappropriated $10,000. The firm's total assets are, and before tax net income are 14 and 3 million respectively, assuming there is no other issues that will affect the report. The external auditor. One thing, it's immaterial compared to 3 million net income. 10,000 can be assumed immaterial. So manager, the auditor might not consider this as material. Remember, I said to give it as a qualified opinion, it has to be material. Look at the last question. Misstatements in the aggregate are material. Altogether, it's a material amount, but not pervasive into the financial statement. That means it's specific to one or two transactions. It's not there everywhere. Fine. But in this case, yes, it is not pervasive to the financial statements. Just one transaction only. And the amount is immaterial. So still he can go ahead with unqualified opinion. Which of the following is the best definition of the going concern concept? Going concern, the company will continue to operate until foreseeable future. Here, entity will continue in operational existence for the foreseeable future. So that's all about the external auditor and the opinions. So if you see here, this part, unit 7 is done in section E. I have another 3 units to finish: system controls, internet security, business continuity planning. So in the next 1 or 2 videos, we will finish these 3. Thank you.